Let's go broader market now, because our next guest says rebound trades and growth names will be leading the market higher. Joining us is Lori Calvasina, RBC Capital Markets head of U.S. equity strategy. And of course, we still have our value investing stalwart, Charlie Bobrinskoy, for an old school debate here, growth versus value. Lori, what is your case? Because already we've seen that it's been working. Nasdaq's up 23% from the lows. Why does it continue?
Yeah, so look, what we've seen since May 24th in the market, you've seen the growth trade start to outperform the value trade, and you also started to see the most popular names in hedge funds start to outperform the broader market as well. And I think what happened around that point in time was, to some extent, the hedge fund selling, the degrossing simply got exhausted. We had already also seen that if you look as far back as 1Q, hedge funds had gone back to mid-2016 levels of positioning in things like consumer staples. And when you look at defensive sectors more broadly, they were at peak valuations relative to both cyclicals and secular growth. So I think we got to a moment in time where the sort of defensiveness just simply got overdone. And that is something that we do typically see at market bottoms, that the defensives just get so overbought you can't stomach buying them anymore, and people simply don't need any more of them. And so what you have to ask yourself is, what is the next thing investors need to do? Where investors have not been positioned is for the rebound. And they simply haven't had enough exposure to the growth stocks relative to, where we think things are going to be heading long term in terms of overall economic growth expectations. I think you also got to this point in the reporting season. Look, I do think that numbers still need to come down in dollar terms. But if you look at earnings sentiment, the rate of revisions to the upside, a lot of these big growth sectors and some important subgroups like internet retail, there were simply no upward revisions anymore. So earnings sentiment looked pretty washed out. That's something we also tend to see at market bottoms, and that really spelled opportunity, I think, in some of these growth names.
Charlie, take the other side, which I know you want to.
Absolutely. Well, obviously, since May, growth has outperformed, but if we look at longer periods of time, value has crushed growth this year. I mean, the Russell 1000 value index is down only about 7%, and the Russell 1000 growth index is down over 17%. The value has outperformed growth this year by about 1,000 basis points. And then over longer periods of time, if you go back to the 1926, when University of Chicago developed Center for Research and Security Prices, value has beaten growth in every 10-year period, except for the last 10 years when growth beat value. And as I said earlier in the show, the reason you have to look at what's the anomaly that caused that, it's this crazy low interest rate environment we've had that discounted future growth from growth stocks, the future earnings that are way in the distant, back at very low discount rates. And so that's been very helpful to growth stocks. But that's an anomaly that's going to revert eventually to the mean. With a normal interest rate environment, value will do better.
I think also what's relevant here is just to define what you both are talking about. Lori, what are growth stocks right now? Are you talking about unprofitable stocks that are in the ARK Innovation ETF? Are you talking about Apple or Alphabet and Meta, some of which were classified as value a few months ago?
Right. So I think that generally, we like the sort of large cap growth part of the market, the technology sector, consumer discretionary, the communication services sector. And yes, some of that weight has been shifted into value. But at the end of the day, what we typically see with those three sectors, if you bucket them together, what we tend to see is that they outperform when economic growth is sluggish. And we typically really only see the value part of the market, which is driven by things like financials, commodities, also the industrial sector. They tend to outperform when the economy is hot. And so all the things that we just heard about how great the value stocks have been over the past year or so, year to date, that is really a function of a hot economy going above trend. Trend is about 2.5%. And that's really fading into the background. If you look out at where economic expectations are for next year, they're hanging out at about 1.5%. My economist is a little bit more conservative. But over the last few decades, and this is not a short-term anomaly, over the last few decades, if you think the economy is hot, you want value. If you think the economy is going to be cool, and that's frankly where I think it is heading, even if we avoid recession, you do want to be in those longer-term secular growers.
I do feel, Charlie, that is the biggest point that growth investors have, is that we're heading into a slower economic period, potentially even a recession, where usually you want growth in that time.
Well, and that's clearly the consensus. The analysts and money managers, by many metrics, were never as bearish as they've been the last couple of months. The calls for a recession are everywhere. I admit that's the consensus view, but that's, of course, exactly why value stocks have gotten so cheap. I mean, my portfolio is trading right at 10 times earnings. Names like Goldman Sachs trading at 9 times earnings, or Borg Warner at 9 times earnings or Apache at 4 times earnings. So they are cheap because everyone agrees with you that we're going to have a recession. We may have a short one, but you have to invest for the long term. And it's a mistake to invest trying to predict a recession.
It was a good discussion, good debate. Lori Calvasina, thank you. Have a good weekend. And Charlie, before we let you go, we're looking at another strong rally. Just to recap the week we've had, up 3.2% on the S&P 500. It's the 4th week in a row of gains. We're down still for the year, only 10.25%. I say only because it was a lot more than that. Remember, we were in a bear market. So what are we in now?
We're in a bifurcated market. I'm sorry to be a little repetitive here, but the numbers you just quoted were for the S&P 500, which is dominated by big, large cap growth stocks. Value stocks aren't down nearly that much. I think my fund is going to be down about 3% for the year. So huge bifurcation, different kinds of popular stocks. Everybody wants to own Amazon and Google and Meta. There's a lot of opportunity in value, which is holding up very well. Still great valuations in that part of the market, still very expensive in the technology growth space.
What's your favorite name right now?
If I had to pick one, and it's always hard to make me pick among my children, I am going to say, and this is, sit down, Madison Square Garden Entertainment. They are going to open.
You say that every time.
Well, I'm consistent. I'm a long-term investor. They are going to open up the Sphere in Las Vegas. They just signed U2. It's going to be the anchor tenant. It is going to be a spectacular place to watch a concert, and people are going to go by the boatload.
Charlie Bobrinskoy, thank you very much.